Thank you for joining us at the Hudson Valley Westchester Regional Meeting that we're trying to do annually. So it's so good to see some familiar faces here, some of our bank members here today. I want to give a big thank you to Bill Calderera and the team at Ulster Savings Bank. He is our board member for hosting us. I also want to recognize our association chair, who I believe is running a little bit late, like me, didn't realize he was going to have to scrape some frost off of his car this morning. Mike Gilfeather, President and CEO of Orange Bank and Trust Company, and our region chair, Mike Quinn, who is also not here at the moment, but he will be here joining us, President and CEO of Rhinebeck Bank. These three great leaders, along with Cheryl Bowers, who is also our board member here. These four great leaders, I'm going to correct Karen Armstrong on this, four great leaders, and so many of you in this room embody banking's fundamental mission, as well as our association's fundamental mission, which is commitment to community. And I can think of no better way to demonstrate our commitment to community than to invite many of Ulster's local business and community leaders here to share this event with us. Obviously, banking impacts all of us in our organizations, and you all play an integral role in our economic ecosystem in this region. It is our pleasure and honor to have you joining us today. And now I'd like to turn the program over to Bill.
Thank you, Claire. We're delighted to host the New York bankers here at Ulster Savings. I want to welcome everyone. I'd like to recognize several of our leaders in the community are here today. So we have our Kingston Mayor, Steve Noble, our Kingston City Controller, John Toohey, Ken Juris, Interim Director of Finance with Ulster County, and Adam Kroll, Deputy Commissioner of Finance with Ulster County. For anyone not familiar with Ulster Savings Bank, we're a mutual community bank, which means we have no shareholders. We were created for the benefit of our customers and the community. We were founded in 1851, and in 15 days, we'll be celebrating our 172nd anniversary. Thank you. And for those 172 years, we've been a pillar of stability and strength to serve our community. We're fortunate in the Hudson Valley to have many wonderful banks headquartered here and to serve the variety of the banking needs, many of whom are represented here today. So on March 7th, when we sent out the invitation for this event, we said it was a topic to discuss. The topic of discussion would be current supervisory issues and challenges. 3 days later, we saw the failure of Silicon Valley Bank, and 2 days after that, we saw the failure of Signature Bank here in New York. Claire and I, along with a delegation of other bankers, were in Washington last week, where we met with lawmakers and reminded them of the strength and resilience of our industry. So we're very fortunate to have this morning someone who can address these issues from the perspective of one of the industry's chief regulators. At the end of some brief remarks by Dianne, Claire will come back up to moderate a Q&A session. So without further, I'd like to introduce Dianne Dobbeck. Is the head of Supervision Group of the Federal Reserve Bank of New York and a member of the New York Fed Executive Committee. In this role, she oversees bank supervision and regulation for financial institutions in the 2nd Federal Reserve District. Her professional experience includes providing strategic direction and coaching to teams of subject matter experts, financial analysts, and examiners. So please join me in welcoming Dianne Dobbeck.
Hello, it's a pleasure to be here. I am delighted to join your regional meeting. And can you hear me okay? Okay, great. And I'll say a few remarks, and then I'm really delighted to answer questions you may have. First off, I just wanted to reinforce that banks of all sizes that serve communities like you do are critical to the nation's economy, and we recognize that. In our time together, I'll talk about the present environment. Obviously, a lot has changed since this event was first advertised. I'll emphasize the importance of contingency planning, and then I'd also like to spend several minutes describing or demystifying some of the Bank Term Funding Program. That's a temporary lending facility that was created by the Federal Reserve Board with approval of the Treasury Department. Before I begin, I must note that my remarks are my own. They don't necessarily reflect those of the Federal Reserve System or the Federal Reserve Bank of New York. That's a mouthful. All right, so let me begin. As Vice Chair for Supervision, Michael Barr said just yesterday, our banking system is sound and resilient with strong capital and liquidity. And I know you know that from the seats that you hold. The Fed, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in the banking sector. Those actions demonstrated that we're committed to ensuring that all deposits are safe, and will continue to closely monitor conditions in the banking sector and are prepared to use all of our tools for any size institution, any size bank, to keep the system safe and sound. A changing economic environment poses new risks to banks, and we remained attuned to them from a supervisory perspective. The management of interest rate risk is one example, which I know you're very familiar with. The composition of deposits is another. And key risk management considerations will vary with the type of deposit. We want you to consider the funding implications of any type of deposit, and then planning for future contingencies is paramount. Let me spend a few minutes on the Bank Term Funding Program. To support American businesses and households, the Fed established this temporary program to help banks meet all of their depositors' needs. The program allows banks to borrow against safe treasuries and agency securities at par for up to 1 year. It is an additional source of liquidity against high-quality securities, and it will eliminate institutions' needs to quickly sell those securities in stressful times. Eligible borrowers that already have discount window access with the Federal Reserve have the documentation in place and are eligible for what we consider primary credit can borrow from this program immediately. Advances can be requested under the program for at least 1 year until March 11th, 2024. That is when the program is currently scheduled to end. We have a number of FAQs available on the Federal Reserve Board website, and as outlined in those FAQs, the Federal Reserve will disclose information concerning the facility that could include the amounts borrowed, the institutions, 1 year after the program ends. So that would be in 2025. If you have questions, please contact Federal Reserve Bank staff in the district in which you're located. For many of you, that's going to be with us here at the New York Fed to determine what type of documentation is needed, necessary, and how to initiate in advance. I guess in closing, I'd like to note that, and this is, I know, important to everybody, that the program is not going to raise supervisory concerns. So if an institution uses it, we think that could be part and parcel of a very sound liquidity risk management program. Together with internal liquidity, stable deposits, other sources that a bank may have, and discount window lending, the program should provide, in combination with those other things, ample liquidity for the banking system. I guess in closing, I'd like to underscore comments from Vice Chair Barr that he made yesterday in his testimony that our banking system is strong and resilient. I thank you very much. I look forward to your questions, and shall we begin? All right, thank you.
Thank you so much, Diane. I just want to say something just as we start here. It's been quite a couple of weeks, but I really want to echo and thank you for saying what you said first and foremost. When we were in Washington just last week, a couple of us, that was our message as well, about how banks of every size and every type, every geography, every region are important. We're so lucky here in New York to actually have every type, and you know, from the smallest to largest. That's always what I talk about. We have banks of 2-branch size on the border of Canada, all the way up through and including some of the largest financial institutions in the world here in New York, and it's such a benefit to New Yorkers. So I appreciate that you said that, and that's our message to Congress, and we thank you for recognizing that, and we hope as we continue to walk down this path and unpack everything that happened here, that everybody keeps that in mind. It's so important. So thank you for that. I'll start here, and then I'll get you all warmed up, and then maybe if you have some questions, we can you'll just shout them out to me, and I'll repeat them so everybody can hear them. So you did talk about the overall assessment of the banking sector, strong and resilient, and that calm and confidence. We thank you for that as well. Such a big part in what we were dealing with in the last couple of weeks. But from your vantage point, what are the greatest risks currently facing banks and the broader financial system?
Sure. So thank you again for having me. And I was able to join many of you in New York, which was lovely. And I hope to be able to come to other regional meetings. I guess I would say that I think it's important, as you started, there is no one-size-fits-all approach. Each of you has different business models. You serve different communities. We have to continue to get the word out. I think some of what we were concerned about was the potential for contagion, because people didn't perhaps understand that each of you is funded differently. You have different communities. The richness of the diversity is something that we want to celebrate. And you know, when there's a lot of stress in the market, you want to make sure that you can differentiate yourselves. I think that's what we're worried about over the past couple of weeks. Not that any individual firm here or in this district was having difficulty, but rather how is it that we could confirm and assure everybody that the banking system is safe and strong, even though there were some institutions who clearly were having difficulties and ended up, you know, as Bill started, it's been a very memorable couple of weeks.
That's great. So I'll turn now, and I'm so glad that we talked a little bit about the Bank Term Funding Program. We've been getting a lot of questions about it in our shop. We call it the BTFP. I don't know if we're all going to that yet, but we're there. Yeah. Okay. So what effect have you seen in creating that program? Have there been improvements to the situation? Are you seeing a lot of banks utilizing it?
Sure. Yeah, so one thing we wanted to demystify is that in thinking about contingency funding, I guess this, you know, maybe a way to think about it is it brings it up in the queue in terms of what you might think about in terms of funding possibilities. It's a program that allows for up to 1 year of borrowing for Treasury and agencies at par. The disclosure would occur 2 years from now. It's really meant to be an ability to have a different source of liquidity to tap should you need it. I guess the one thing that we would also offer is not everybody, although you may have access to the discount window, we know that the Federal Home Loan Bank is another important source, you know, for many in our community. The discount window is also available, and there are some operational we want to make sure that everybody has the operations in place should they need it. But I would think about the program as something that's sooner to access than the discount window, which is typically seen as sort of an overnight last resort. But we want to make sure we're here to help. We're not here to replace, but to supplement. If you were using the Federal Home Loan Bank exclusively before, we want to make sure that there are other options available to all the banking organizations. There are some attestations that are required. If you've tested with the discount window staff, it's a very easy process, and it would be up to you to use if you wish. And we do want to reassure everybody. I know that in the previous crisis, there's some stigma, could be some leftover stigma for using some of the programs that were set up. We truly want to assure everybody that this program is meant to be available to all of you, and supervisors will not look unkindly at the usage. I can assure you that.
That's great to hear. Yeah. It's sort of another tool in the toolbox.
Absolutely.
You talked about the Federal Home Loan Bank, the discount window. This is just another thing that you can use to shore up, to create more confidence, perhaps, and help customers feel like things are a lot more stable. And I think it's only been announced. This is now the second week, right? So
Right.
So
Yeah.
you've done a great job getting
Yeah.
all the information out and getting this getting the information that people needed out to people. Last week, one bank CEO described mobile banking as a complete game changer as it relates to bank runs and how management and regulators respond to them. Also, social media, I think, probably a factor here. Do you agree with that view? And how should lenders be thinking about the role of technology and social media in banking after recent events?
Sure. So, I mean, obviously, there's a lot of benefits because customers want different avenues for accessing their deposits, and so a mobile app provides a lot of convenience. I think the flip side, as I understand it, from what happened with the two recent bank failures, is that it also allows for very immediate and precipitous change in deposits. And social media also, as we all know, is a vehicle for spreading news quite quickly. And when the news is accurate, it's helpful, but sometimes when in the fog of war, it's difficult to parse the signal from a lot of the noise. So I guess as I understand it, in the recent events, the ability to have mobile banking amplified the immediate exit of deposits, and social media helped put a spotlight on it as well. So there's a plus and a minus to it, but I can obviously understand how, particularly for uninsured deposits, this could, amplifies and then put stress on institutions that rely heavily on uninsured deposits. So it's just something else to consider in this fast-changing world about how does one think about banking franchise, deposits, making sure that all contingencies are taken into account. Because I don't think we've seen the use of social media quite like this until now. Yeah.
The New York Fed, NYBA, and banks across the state have like-minded goals of strengthening our communities through economic and social improvement endeavors, yet it can feel like our agendas are driven separately toward those outcomes. How can we work better together in the future to further these common interests in New York?
Well, I would say thank you for continuing to extend invitations to me and my colleagues. I'm delighted to be here and would like to continue the dialogue. And I guess I may ask if you could continue to spread the word about how we're here to help in this particular circumstance, particularly with the program that I just spoke about very briefly, kind of demystify some of the questions that are out there about whether or not, how long is it at par, how do you have access to it? That would be really helpful. And then also just in a contingency arrangement, just as I know you have close relationships with colleagues at the Federal Home Loan Bank, just as a contingency refresh, if you haven't done so recently, your contacts at the discount window. Have you tested? Do you have collateral? Just in the case you may need it, we're here to help. I think that's by me being here, I'm really trying to help impress upon that point.
That's great.
Yeah.
That's great. And we do have some, I believe, some business leaders and some local government leaders in the room. Do you have any message for them as we continue down this path?
Sure. I would just say where I began. I mean, community banks are critical. And thank you. Thank you for supporting your banks. Thank you for the banks serving the communities that you serve. I can't thank you enough.
That's great.
Yeah.
That's great. Any questions from the room? Yes.
Sure.
I think we're all expecting a laser-like focus on liquidity
Yeah.
from regulators and more upcoming exams. With that in mind, I think a big part of most community bank strategy is what we were talking about, the ability to balance part of the liquidity strategy. That being the case, I guess I'm just sitting here concerned about, how much is there going to be focused on balance sheet liquidity versus borrowing.
And I'll just repeat it for the folks at home.
Yeah.
We're talking about we're expecting a laser-like focus on liquidity, and what can you tell us about future looks at liquidity and the balance sheet?
Sure. So I would say I don't expect a significant change in approach. Obviously, the dialogue we want to have with you and any of your peer institutions is just to understand how you're thinking about and how you're managing your liquidity and contingency. I don't think there's a preference for any particular source. From our perspective, it's just helping to understand what are the challenges that any bank, not in particular, may be facing, and how can we help think through or help you think through what might be other options. So I'm not expecting a significant change in how we've approached it, just holistically and understanding what your model is, how have you approached it.
More of a risk management.
Exactly.
In general.
Yeah.
Okay.
But if there's something in particular, I'm happy to talk bilaterally with you as well, because I know it's difficult in a room of a lot of peers.
Any other questions? Yes.
Please, yeah.
Good morning.
Morning.
With the, at this point, no limitation on FDIC insurance coverage for large banks.
Yeah.
And now the implied no limitation on large regional banks. What can the FDIC do to level the playing field for community banks?
Go ahead.
Sure. So this is about FDIC deposit insurance and talking about sort of the different types of banks and the impressions of what is covered at this point, and how do we level the playing field in that respect?
Sure. So obviously, this would be best positioned question for the FDIC, but I can give my understanding of current events. So the failure of the recent banks indicated that when they went into the bridge bank, that the FDIC is guaranteeing both insured and uninsured deposits. And I think a question you may be raising is, what is the level of guarantee, not in a receivership, but just an ordinary deposit? Will that level be reconsidered in light of current events, and if there's a bank of different sizes? I'm unsure about that, but I do think it was remarkable that there is, the FDIC noted that it is guaranteeing both insured and uninsured deposits, because that's important. I don't think that there is a differentiation, meant to be a differentiation to preference one size bank over the other, because we think deposits of all sizes and all types of institutions are important. I guess the one message I would send or emphasize is, in reading the testimony that took place yesterday from the head of the FDIC and Vice Chair of Supervision, Michael Barr, for the Federal Reserve, a high dependence on uninsured deposits is a watch point. And it's incredibly important to understand how quickly those deposits, for the reasons we just talked about, may or may not remain with you or exit, and then how to have contingency planning around it. So I'm not in a position to give insights into what the FDIC is thinking, but obviously I think it's important to think about the deposit base and your composition and how you may, whether it makes sense for your business model and in light of recent events. Yeah, I hope that's helpful.
Yeah, very much. And if I could just say something,
Please.
I'm not speaking on behalf of Dianne, but I'll say on behalf of the New York Bankers Association, that was exactly our message in Washington, that every bank is important. Everyone plays a role in the ecosystem of our financial system, and so as they're figuring out what to do next, really think about that and how important it is to have a smaller community bank, a mid-sized bank, a large bank. They all play a different role, and so we have to make sure there is a level playing field. So I appreciate that question.
Yeah, absolutely. We want your banks to be vibrant. We want the whole system to be vibrant. So I think that any policy choice that may be made in the future, perhaps I could speak about that for a moment. There's been a lot of discussion about what policy changes might be considered. And I think it has to do with what might have been some root causes or what might have been some gaps in our supervision and regulation, and trying to think through what could it look like, mostly in the spirit of making sure that everybody is prepared as possible. But I don't have a view on what those changes could be, if any.
Great. Thank you. Any other questions? Yes.
Just an observation.
Sure.
And it's very important, and I think folks like yourself and politicians did a pretty good job in getting out in front of this, because social media, as we know, can be just lots of misnomers, and it's friend of mine who's a geologist, who knows lots about rocks and bugs that I don't know. He understood it really well. And so I think it's just reiterating that it's so important for the agencies and for the politicians to really get out in front, because the ability to spin this thing in the wrong way could have happened. And I think a bit of that did happen. But so again, I think just kudos to you folks for getting out, and I think that certainly helped all of us.
Well, thank you for that. And we have direct contact. So if you're hearing from our supervision teams, I know this doesn't apply to everybody because we also have business leaders that aren't running banks, but our team should be reaching out to you. If you have any concerns, please reach out to them, reach out to me. We just want to make sure that the information flow is frequent, clear, and try to answer any questions. And if there's something that's confusing, doesn't sound right, or if there's a market development or a community development that you think that's important for us to hear, please, by all means, we are available and we'd love to hear from you. And it's important that we understand how things are happening on the ground from your perspective, from our perspective, from supervision, and we're sharing that information with peers. I'm one of 12 that is the head of supervision at a reserve bank. And I can tell you we speak frequently and want to share what we're hearing, what are similarities, what are differences, not about specific firms, obviously that's confidential, but more about trends, what's happening, where could we provide more clarity, where are there questions similar to what the gentleman to my right mentioned, how can we escalate those questions and open items for consideration.
And we're happy to help also as an association. We have built now a web page for everybody with any resources we can find. So you have a one-stop shop, right, with all of the information. You talked about your FAQs, they're on there. But if we can be a conduit in any way, we're happy to help. Any other questions? Yeah. Oh, everybody's going at once. I'm going to call on the mayor.
Sure. So this is more of a broad question.
Sure.
We know that in our communities, both here locally and across the country, folks are struggling with the cost of housing, and with the current, banking crisis that unfolded a few weeks ago. I think that there's a thought that there may be lenders that are more, will maybe take another look at their portfolio and whether or not this potential homeowner may actually be qualified for a loan. And then with rising interest rates, as I said, I think that we're seeing a very narrow market now for folks to be able to get into and to be able to afford housing, especially here in our community where housing prices have doubled in the last 2 or 3 years. And so I guess this is also maybe more of a statement for some of our local banks of what can we do to be able to still make sure that our housing market is open and accessible and affordable before it ends up becoming a market that only folks with relatively high incomes can actually access.
So I don't have the answer, but thank you. Oh, please.
Can I just, so we get through, just talk about, we're talking
course.
about what comes next, right?
Right.
And a concern about the housing market here in Kingston. You know this, I'm sure already, a boom of people moving out of New York City up into the Hudson Valley during the pandemic. And so you saw housing costs rise from that. And I think the concern here is we want to make sure we're keeping the housing market open to all as interest rates continue to rise. And there's sort of a crunch there. So
Yes, so this
I hope I
is-
captured some of
Yeah.
that. Okay.
Oh, pardon, I'm eager to say I'm unsure of what the answer is. We have this is obviously a topic of importance. We happen to have a STDIAC meeting tomorrow where I'm sure this will come up again. It is, and President Williams, whom I know has visited with you all frequently, when I think he'll be going to Connecticut, I think soon on Friday. This is a topic of discussion. We want to understand, and we observe much of what you have mentioned in other parts of the state and in the region. I don't have the answer, but I know that affordable housing is critical. And so I can't speak to, I guess I would say my impression of the current events has been more about interest rate risk management, liabilities, having exposure to certain depositors that exited quite quickly and were not the traditional customers. They didn't have other relationships with the banking organizations. I think that mix is a little different from, in speaking with some of you about what the profile is of the banks here. But I do appreciate that housing and affordability, it's critical for our economy.
Yes. In the back? Yeah?
I'm wondering, and it's a little bit in line with Mayor's question, but from a different angle, are there regulatory concerns about any particular credit asset class in light of the interest rate policy?
Sure.
Making, say, commercial real estate a little more complicated?
That, please. I'm eager to answer.
I think,
Yeah.
you go ahead. I missed the
Sure.
first part of it, so you
So
go
I
ahead.
think the question is, are there asset classes such as commercial real estate? So I had briefly touched upon this topic when I spoke in December. We clearly have a concentration of commercial real estate lending here in the New York area, and particularly in the metropolitan New York City area. I wouldn't say it's a concern level at the moment, but clearly, the current interest rate environment or changes do impact that market significantly. So we're watching it carefully, and I guess I would make the same invitation that I've had. If you've got insights you think are important to share, we'd love to hear them. I don't see anything. It's not at a. It's a item that we are watching, maybe not a watch point item necessarily because of the recent events, if that's helpful. Yeah. Right.
Yeah, I was about to say that.
Right.
Is that having an effect on it as well? And you're talking about occupancy rates post-pandemic, I would assume, or are we post-pandemic? We hope. So occupancy rates are down, obviously, and I think I'm assuming here in the Hudson Valley, obviously, I'm in the New York City area as well. So is that having an effect, and is that part of the watchful eye?
I guess I would say from a bank supervisory perspective, it gets back to the point you had raised a bit ago about risk management. How is it that we are observing you all making decisions about commercial real estate? It's not from the supervisory perspective. We're not able to influence occupancy rates. We understand it's a factor that goes into the commercial real estate market. So it's things that we are aware of, but unfortunately we're not able to and rightly so. It's not our place to help to make a decision either way.
Well, it's a combination of employment issues, right? I mean,
Yeah.
20 years ago, 10 years ago, you could have said to people, it's time to come back. The desk is here.
Oh, for hybrid
I
work.
can't do that,
Yeah.
right? So,
Right.
because of the employment situation.
Yeah, it's very complex.
I don't know where that
Yeah.
ends, but,
Yeah.
the name company, but it's New York City, we don't lend to them, fortunately, but 40,000 square feet, at one point they had 5 people in those offices. So they're slowly coming back.
Yes, we've heard. I think this is just to rephrase. Do you want to rephrase the?
Sure. We're
Yeah.
still talking about occupancy rate and how it's very slow, particularly in New York City, very slow to get back into the offices as they go back in, and how is that affecting things?
Yeah, clearly that's an outgrowth of the pandemic and trying to understand due to close proximity and hybrid work preferences. I know various companies have different. I don't know if they've found the secret sauce, so to speak. To try to encourage or employees to come back to the office. I think everybody's testing it out from what I understand.
Yeah.
Yeah.
Yeah. It's a brave new world.
Yeah.
And was there another question over here? Yes.
I was just going to ask about the interest rate environment and the rapidly increasing interest rate environment, how that was impacting the deposits and liquidity at local banks even before the recent bank failures. So the money was moving into treasuries, banks were then increasing their Fed borrowings. At the current levels right now, any comment on where the banks are positioned with regards to borrowings and liquidity and the impact of future interest rate increases?
Sure. So I'm not, interest rate risks are certainly not my discipline, although I know the Federal Reserve plays a big role. Maybe I'll abstract a bit and unpack what you had mentioned. I agree that the unrealized losses on securities is when, if there is a liquidity issue and securities are underwater due to when they were purchased, that can create, when sold for liquidity, capital implications and earning implications. I think that's why it's so important, maybe where I started, the availability of this program, the Bank Term Funding Program. If you're looking for liquidity options, being able to borrow against securities at par for up to a year, we just want to give other alternatives that may be more attractive than selling the securities outright and having to realize those losses. So I don't have observations. I mean, I think generally across the country, we've got many banks, and I'm sure they're in your community too, that are managing this very well. But it is holding securities to, for the long term shouldn't be an issue. But when there are needs for liquidity in the short term that haven't been anticipated, that's what we want to try to help with, and that's what the program was developed for. So I hope that helps just give some perspective from where I sit about why some of the banks, as I understand it, felt pressure, those that failed most recently.
Do you have a follow-up?
Yeah.
Or a
Yeah.
discussion? How's that?
Maybe an observation, so just based on, that is a good resource,
Mhm.
good fallback, but and kind of piggybacking on the real estate question, basically with the liquidity moving from the local community banks into either investment houses or the too big to fail banks, and I think that's a media misconception that
Yeah.
it should be moved to the too big to fail banks, and I don't think the media is doing the local community banks justification in getting that word out there that we are safe, we are sound, and we need to relend that money back into the communities.
Yeah.
And what I believe is going to happen is we are going to have a credit crunch with regards to commercial real estate, because as the money flees from the local community banks, there's not going to be able to reinvest in those loans that are coming due, and we have a boatload of commercial real estate loans maturing over the next 2 years. That just supply is going to way out its demand, and we're going to have a little bit of a credit crunch, and that's going to definitely hurt commercial real estate.
Did you want to rephrase?
No, I
or-
think he's
Okay.
on the mic, so he's good.
Sure. So I guess what I would say is we want to, the misperception, and I think this gets back to the original question about some banks being safer for deposits versus others, that's a misperception. And we want to help spread the word and reinforce that deposit is safe with a community bank as it may be with a bank of a different size or different business model. So that is absolutely in our focus to help reconfirm. And I think hopefully many of the efforts of the FDIC actions, the actions of the program are meant to help reinforce that point. But I agree, we feel steadfast that a deposit that is with you versus a deposit that's with a bank of a different size or model, they should all be safe.
Yeah, very good observation, and I agree with everything you just said. I think it's a very difficult misperception at the moment. And to your point, you're talking about lending into the community, and I think everybody recognizes, this is what I was saying in the beginning, the role that community banks play versus a regional bank or a larger bank. That money, you want it to keep it in this community, and it makes a lot of sense that we do everything we can to take that perception away from the public. So I appreciate that. Any other questions? Thoughts? Okay. I think we're about. Bill's going to take us home here.
Great,
But if you want to,
thank
do you have
Yeah.
any final
No,
comments?
simply to say that wearing my supervisory hats, please, we are here to help. Please pick up the phone if you have any questions. If you have a supervisory team that you want to have more contact with, let me know. I look forward to engaging with you. And thank you.
Thank you.
Yeah. Yeah.
So thank you, Dianne and Claire. Thanks, everybody, for attending. Thank you for those wide range of questions that I know will really
Of course.
affect us all. So we truly do appreciate that. I want to thank you all for joining us today. We had our elected officials, our bankers, our business owners, and our community leaders. It is gatherings like this that will help us foster understanding, collaboration, and get rid of some of those misnomers. There is different information. All of our banks are important. Many are safe and sound. Steve, I will tell you that we are committed to the community and committed to lending. Not all community banks are losing deposits. We're actually still gaining them and going strong because of the strength and because of our community, because we represent our community, and our community actually supports us, as they do many of our colleagues in the room. So thank you all again, and we appreciate it. Thank you.
Thank you. Thank you. Thank you. My pleasure.